Hey fools, typically when prices rise, demand falls. Well, that is unless you're a borrower looking for a non-traditional mortgage loan. Non-traditional meaning an interest-only, a loan with an alternative amortization schedule, a hybrid adjustable rate mortgage product perhaps, and so on. These are not the subprime borrowers with poor credit scores or with higher debt-to-income ratios. These are simply borrowers who want a mortgage payment maybe that is lower in the first 5 or 6 years and then escalates from there, something that's just irregular from a traditional mortgage. The Federal Reserve has recently released some data showing the supply and demand in this marketplace, and I have a graphic here to show you now that shows on the blue line banks that are on net tightening their credit standards, which we can see banks have been pretty stable for some time now. And then on the green line, it shows demand, borrowers coming in interested for these products. So what's interesting here is that since the summer, say May, June, mortgage interest rates rose pretty rapidly. On the prime quality, on the good, traditional, high credit quality mortgage side, there was a steep decline in demand based on those rates rising. We don't see that in the non-traditional. So as an investor, if you're concerned about interest rate sensitivity, because we know rates will continue to rise sooner or later, probably sooner, but we know it's going to happen eventually, this presents an opportunity to mitigate some of that risk. I'd point to Bank of America. Huge bank, lots of mortgage operations, prime quality, subprime quality, non-traditional. But the non-traditional is what's interesting because the non-traditional can mitigate some of the decline in the more price-sensitive products. Bank of America originated 32,000 loans in the third quarter to low to moderate income individuals that are prime borrowers for some of these non-traditional products. The bank originated 5,000 loans to first-time home buyers. Again, these are borrowers who may not have 20% to put down on their home, and maybe a non-traditional product makes a lot more sense for them. 78% of Bank of America's mortgages were refinances versus 22% for purchases. So there is some risk there, but as long as they're reaching out to individuals who don't have the same price sensitivity as some of the highest credit quality individuals, the bank can mitigate some of that decline as prices rise. On the flip side, a regional bank like Regions Financial, for example, who doesn't really mess in the non-traditional or subprime worlds, which from a credit quality perspective is as positive, they're going to see a lot more sensitivity as rates rise, and their incomes are going to fall more precipitously because there's no offset. For example, in the third quarter, Regions again saw a 25% reduction in its mortgage income that was driven by a 16% reduction in mortgage production. Why? Demand fell precipitously for the bank. Now, B of A obviously had the same kind of problems, but again, the key here is that there was something to mitigate that decline. So if you're a bank investor and you're comfortable with a non-traditional portfolio of mortgage loans, look to banks that do business there as a way to mitigate interest rate sensitivity as we go forward over the next 6, 12 to 24 months.